Is it possible to beat the market simply by maintaining perfect risk management and discipline? To answer that question, I wrote a script that assesses the win rate and expected value of any risk to reward ratio by simulating price movements based on the behavior of any asset you are working with. After loading in minutely data, we use pandas to take the mean and standard deviation of the close price changes. To replicate the movements of the asset, we multiply the standard deviation by a random number of standard deviations, or z, generated by NumPy's random standard normal function, and then we add the average movement to that product. We repeat this process for as many steps as we want. Because there are 450 minutes in a trading day, I set the limit to be 450 steps. We can also choose how many different times we want to run this simulation. This is what one day of simulated movements would look like. Here's 10, and here's 1,000. So the theoretical probability of a successful trade is shown using this formula. If you have a risk to reward ratio of 1, then you should expect to win 50% of your trades, a ratio of 2, 33%, and so on. But this formula doesn't account for variance. It assumes that prices suddenly start drifting up or down when you place a trade. As we know, this is not the case. When you take previous price information to determine the mean and standard deviation of price movements and limit your trades to 450 minutes, the simulated probability of hitting your take profit with a risk to reward ratio of 1 is actually only 34%, giving you a negative expected value. Once your risk to reward ratio increases above 1.5, your simulated win rate drops straight to 0. If you increase the maximum duration of your trade to 10,000 but decrease the average movement to 0, the simulated win rate follows the theoretical win rate pretty closely, but the expected value of your trades are always negative. And that's before accounting for fees. According to this study, there are only 2 ways to increase the expected value of your trades, and that is by increasing the average drift, or increase in the duration of your trade. The risk management system itself doesn't actually give you an advantage. The edge has to come from selecting the right assets and timing your entry effectively. Our goal is to give all traders and investors a more competitive approach to trading through resources like this. The complete walkthrough and code base for this project is posted for free on the Sharp Research Education page, and if you're interested in a more detailed overview on the results of studies like these, sign up for our free newsletter, The Slice. Competing in an efficient market is not as simple as some people are going to make it out to be. So until next time, stay sharp.